Welcome to the Smart Property Investment Show, the podcast by investors for investors.
Well, g'day everyone, it's Liam Garman here, Managing Editor of Real Estate at Momentum Media, the team that brings you the Smart Property Investment Podcast. And I'm joined by man that needs no introduction, Sam Gordon. Welcome back to the studio.
Mate, absolute pleasure, man. Thanks for having me back.
No, mate, we can't say no. We can't say no. When did you come down to Sydney?
I got down over the weekend, man.
Yeah.
So it was a long weekend in Queensland, came down, caught up a couple of mates, and yeah, man, ripping in some pods this week. Got some top 1% pods. I got some Scouting Australia, investor apps to record.
You know,
so
you're always pounding the pavement.
Yeah, man, I love it. I love it. It's good fun, man. It's good fun. And yeah, interviewing some really interesting people, man. So I'm looking forward to it.
I don't know who does your marketing, but they do a very good job. Because now whenever I'm on Instagram, I would say your reels are probably taking about 20% of airtime.
Really?
Yeah,
no way.
And my favorite one's you're in the studio. And you famously said the School of School of Property is like having Sam Gordon in your
back
pocket.
pocket. Yeah,
There was a reel that starts like that, and I see it. I mean, it probably speaks to how much I'm on Instagram, right? But like I see it probably like 4 or 5 times a day.
Yeah, right. Yeah, that's with young Ella Woolcott, man. So that's for School of Property. So Australian Property Scout, we don't advertise at all.
Yep.
But with School of Property, man, obviously that's a bit of a different beast in terms of how we're building that and helping a lot of investors from that end. Yeah, man. So that's the one. I've been getting so many people saying the same thing. They even come up to me in gym and go, "Man, I've been seeing your stuff," and I was like, "Yeah, it makes me laugh, man." So
for people that don't know School of Property, what's the goal?
Yeah, man. So School of Property is pretty much almost all of our clients that work with Australian Property Scout. They almost all have School of Property as well, and effectively it's the education platform that I built. It's something about 110 lessons now. It's about 100 odd hours of content within it too, and it's pretty much all my learnings and takeaways and mistakes. Everything I've learned over the last I've been doing this now for over 15 years. So pretty much everything I've learned over that time frame, pretty much compressed into a course. We do monthly webinars as well, man, where I jump on and I do talk for about 2 to 3 hours, like answering questions from clients and strategizing, scaling portfolios. Yeah, man, and it's sick. So I love it, mate. I'm all about it, man. It was a little bolt on that I kind of wanted to bring into to Australian Property Scout. But what we found as well is there's people out there that also want to build their own portfolios. Yeah. They don't want to use a BA, or maybe they're wedded to another BA they've been using for years or whatever. But they want to know the strategy piece in terms of how I scaled my portfolio as large as I did. And so, yeah, man, it's kind of facilitating the other side of people who want to learn how to scale a portfolio properly as well. So, and man, learn from all the lessons and mistakes that I've made in my own portfolio over the last decade and a half. So
you gave me too easy of a segue. Because mistakes is the aim of the game today, and we hear it all the time. We have so many people that come on the podcast say, if only I could go back and do this, but that's why we have these podcasts. Mate, because
hindsight's a beautiful thing, man.
Hindsight's a beautiful thing. The best time to do something might have been 10 years ago, whatever, but the second best time's now.
Yes.
Right? It's never too late to put yourself in the right space. So you and I are having a chat before the podcast. What do you want to chat about today? And you used a bit more creative language than I'm going to use, but it's not how to. Slightly. It's how you can avoid screwing up your portfolio.
Yes.
So you would have seen some interesting case studies of people that have just made the wrong decisions. Before we get into that, what were some of the major mistakes that you feel like you have made on your journey or with your clients? You've got clients right across Australia. Yeah. What are some of the common mistakes that you've seen with people coming into Australian Property Scout saying, "Oh, well, maybe you guys would have done better had you have done this instead of that"?
Man, I always try to avoid hitting someone too hard with probably the brutalities of how people have walked their journey. Because man, I'm a very direct person, but at times as well, if someone's been trying to do something for years or they made a mistake, and especially if they already sort of know it within their own portfolio, I try not to hammer them too hard on that.
Don't kick them when they're down.
I try not to, man. If someone wants to have a go, I'll have a go. But yeah, man, in all reality, we're all on the journey. Everyone's going through their learnings, man. I'm still learning about different things, in different phases of my portfolio as well. And I think you never know everything. There's always something new to learn, especially in the property market. There's always so much changing as well, and different strategies that can be applied, different policy changes, different government legislation. So there's so many different things that can be learnt, man. So there's so many. The most common thing is following someone, taking someone's advice that hasn't done what you want to do. It's the easiest way to blow things up. Buying where you want to, buying locally or buying something that you could see yourself living in. All those sorts of things, man. I know today, we're going to be running through what's guaranteed to probably stuff up your portfolio. But yeah, man, they're probably the most common things. One of the other big things that I'd probably throw out there before we jump into it is having the incorrect team and staying wedded to the incorrect team. I personally made that mistake for a long period of time. I used a family accountant for a long time. That was my family accountant. Man, and they were average. Same as broker, jumping around with the wrong brokers and wrong bankers and all the rest of it. And then building your A team, man. Even buyer's agent, I used the incorrect buyer's agent when I was 7-8 properties into my portfolio at 25, 26. And I used a BA that I thought was good, man. And I got skinned, dude. I lost out on 10 grand, non-refundable fee. And mate, again, it's all lost. It's all the loss. Loss is only a loss if you don't learn from it. And and as long as you take that lesson and learning from it, it's just an expensive lesson. It just depends how expensive it was.
Yeah, for sure. And I think maybe we start off with that, listening to the wrong people, because it's something that, property is like a sport for Australians. Yeah. Every Australian loves property. Every Australian loves the idea of investing or the white picket fence. Yeah. So it means that, whenever you're at a family barbecue, you're going to get about 15 different opinions from different people. And you're always going to have that pressure, if you've moved around, or if you've married someone from a different city or any iteration, people are like, well, come back here. Or you're going to get the emotional advice. I think is what I'm saying. You'll get the emotional advice of parents want you to live closely to them. So to your point, say you're going for a rent vesting strategy, well, why don't you buy a place that you can move into that's near us? Well, that's actually not going to guarantee you really good capital gains. It might not even guarantee you a good yield.
It might not guarantee you anything.
It might not guarantee you anything. You're just paying out of pocket for a really expensive property that might not really mean too much. So listening to the wrong people, let's start there. What are some case studies that you've seen with that?
Oh, I mean, I think the biggest thing is obviously family and friends, people who mean well but have no idea what they're doing. The easiest way to sort of make a decision around this in terms of who you should listen to is, have they done what you want to do? And that goes for everything across the board, especially family and friends. Like, if your parents have built a 10 property portfolio, maybe they're worth listening to and having a bit of a chat with them around it, combined with other advice and listening to podcasts or School of Property or different things like that. But man, like 999 out of 1,000 people listening to this, their parents haven't built a 10 property portfolio or haven't retired off their own property and investing and stuff as well. So again, 999 times out of 1,000, they aren't the correct person to listen to. And man, like, sometimes you just got to be brutally honest with yourself around this thing, because like, if you fill your head with too much noise, and this is too many different voices, too many different opinions trying to tell you something, it almost guarantees failure, or it guarantees procrastination, because you don't know what to do. And it's going to be one or the other. It's very hard to lock in on a strategy and then hone in and just repeat that strategy and focus on it if you're allowing all these different voices to come in, especially things like rent vesting. If you can't afford where you want to live, and then you would have to, okay, so I can't buy 1.5 mil primary residence, so I can buy a 1 mil, but it's like sacrificing what you want to live, and you don't even really like it, but you're just getting your foot in the door. Why not chop that into 2 $500,000 purchases and go and buy 2 investment properties somewhere where it makes sense from an investment perspective, and rent where you want to live? Because that $1 million, $1.5 million primary residence, you can probably rent it for $600, $700, $800 a week, and versus potentially like a $2,500 grand, $2,000 to $3,000 a week mortgage, because it's so expensive to own your primary residence versus rent vesting these days. So things like that, man. And then even when it comes to building your team, if you're taking the advice from the wrong people in your team, if your broker, if your accountant, if your buyer's agent hasn't built a large portfolio or help other people build a large portfolio, and that's what you're trying to do, man, how are they going to show you how to do it if they've never done it themselves? It's like, it's literally like everyone in that equation, accountants, brokers, buyers agents, everyone, man, if they haven't done it, they can't show you how to do it. Or even if they're giving you advice, man, they're probably not qualified enough to, because they haven't been through it. They haven't been through the school of hard knocks, made those mistakes themselves. Because there's no mistake that stings the worst than the one that like if you actually go through it and it costs you money, that mistake will always stick in your brain, because you're the one that's been burnt by it. So you need people that have been through those mistakes before that can help you navigate how to not make it, how to not make those same mistakes.
Yeah, for sure. And I really appreciate that. And that is key to the kind of APS philosophy, right? For sure. And I've seen you say it multiple times, and I'm going to pluck some figures, but
Let's go.
On our last podcast, we were talking about that you're renting at the moment, right? And the way that I boil it down is that you could, now I'm not going to get the facts and figures right, I'm not going to get the numbers right, but just plucking it out, you could live the lifestyle of a $5, $6, $7, $8 million home with a $1 million property portfolio. Now, even if you completely liquidated your $1 million property portfolio, you're actually not going to get that $5, $6, $7, $8 million lifestyle, right? But because you've built that up, because you played that kind of passive income game, you actually do have, you do actually have the ability to really punch high in how you live, which is exactly what you're saying. You know, why don't you buy the 500K places and then rent and then have the lifestyle which you want?
Yeah, for sure.
You know, and talk to us about your journey with that.
Yeah, man. So at 27, I hit a lending ceiling at the time, a serviceability cap. And I thankfully had quite an experienced broker at the time. And she just pretty much showed me how to navigate my way through it. And one of the biggest like levers that I was able to pull was actually renting out my primary residence and then going and renting somewhere else. And it's an immediate boost to your serviceability because that debt now becomes tax deductible debt versus just, it's the banks look at they look at your primary residence as a liability. It's a non-income producing debt. So the banks, I'll repeat that, the banks look at your primary residence as a liability. It's not an asset. Yes, you might have equity in there, but if it's costing you money, it's a liability. Yeah. And they have signed that entire debt against it. And again, it's not tax deductible. So it's one of those things, man, things like that like can really, really stall the journey. And when I made that transition out of owning that place, that my portfolio went to a next level, went to a completely different level, moved out of that, man, started renting myself. And I've never looked back and I've never bought a home for myself since. And that was at 27, I'm 35 now. So 8 years on, man. And yeah, my portfolio and myself, you know, personal wealth has seriously reaped the benefits of making that decision. Now, what's come alongside it is, and this is what happens so often is people, like you level up so much in life, right? Like if you're in your 20s or if you're in your 30s specifically, you know, more than likely what you can buy right now is not going to be your dream home. So maybe what you can buy right now is a 700,000, a mil, maybe 2 mil home. But in reality, if you can afford that 2 mil home now, like in all reality, by the time you're potentially in your 40s or your 50s, or potentially if you're in your 20s, by the time you get to your late 30s, you could probably buy a $5 million primary residence or maybe more. And so often what we see is people go through this jumps. They pay these little bit extra. They keep trading up in their primary residence, maybe by $500,000 at a time. It's an extremely costly transaction. You've got stamps on the way in, you've got sales costs on the way out. Yes, you're not paying CGT, but there's always that premium.
That friction cost, which is super exy.
100%, man. So like you're costing yourself that every time. Plus that serviceability that's getting killed by owning that primary residence, that liability is stopping you from being able to build your portfolio harder as well. So my honest opinion is if you cannot buy your dream primary residence now and your dream primary residence that you'll be able to afford in 10 years, right? So if you can't afford that now, you shouldn't be owning your primary residence. You should retain that debt, you should retain that serviceability, and you should build a property portfolio that's going to enable you to buy that primary residence in 5 or 10 years.
Yeah. It's so funny.
The dream primary residence.
The dream primary residence. It's so funny when, you know, to hear the Sam Gordon kind of still harp on about serviceability, right? The Mr. on what was it, the Daily Mail 100? I'm not going to give the figures, but
100 plus.
100 plus. The Daily Mail is probably a bit old on that as well. Anyone, Google Sam Gordon. But you know, but going back to the APS philosophy, so whenever you advise clients to buy in a certain area, you hand on heart to say, I trust this area, you buy there as well.
100%, man. I've made it almost like it's an unwritten rule now in the business that when we first go into an area, because I always get on the ground first with the BAs, as we're sort of establishing ourselves in an area, I'll always buy the first deal, the first couple of deals in an area as well, because I just love putting my money where my mouth is. Yeah. And I love being able to get up on the stage in front of however many people when we do our summits and our boot camps and stuff, and be able to say that like confidently and without a shadow of a doubt that, you know, I'll go put my money into an area the same as that I expect a client or you know, the anticipation that a client's going to go put $500,000 or more into a location, into a property, that I've done the same thing and that I've, you know, effectively put my money where my mouth is at the same time. So yeah, man, I love it, man. I'm still an active investor. Absolutely love it, man. Live and breathe it. I'm still doing reno projects.
You still get the adrenaline rush from it?
Yeah. It's a funny thing, man, because I look at it from a business perspective, right? Yeah. So I still get little adrenaline hits here and there on different deals. It does get fewer and further between, but see, so often these days is like there'll be a good deal that's like a heavy renovator or something like that. They're the sort of things that I'll pick up. Almost always like I'll end up buying a crash deal by a client that might be like they might have bought it and something big might come up in a building and pest, which might be, you know, infrequently, but it might happen once a month. And a deal might come apart from that, or when we're doing our inspections, everything looks good. Like even before a client's potentially bought it, but then like we may think it's good, and then we get through and then we just see it's a complete renovator. It's a $60,000-$80,000 job. Yeah, and I don't want to put that on a client because there's so much that can go wrong with them. But as long as the equity piece is there that I can make on the back end of doing a renovation of that size, I'll take because we've got the team, so I'll take that project on. So so often, man, that's what I'm buying, and I'm renovating those sorts of homes. So I like it, man. It's something a bit different. It gives me something to sink my teeth in, and I look at how can I reconfigure a home to maximize it as well. So it's cool. It's cool. I love it, man. But I treat it like a business, so it's just another day at the office.
Yeah, of course, of course. Now, actually, the theme of the podcast is how not to destroy your portfolio. But I do have one question on that before we get there. You're now dipping more heavily into commercial.
Yes.
Yeah. Talk to us through that.
Yeah, man. So we launched our commercial division probably around about 6 or 9 months ago, something like that. We've been doing commercial internally in the business for 18 months. I've been buying myself commercial for over 2 years.
Because that's kind of your main force of effort, I guess, is the best way to put it now, right? The commercial stuff.
For myself?
For yourself?
Personally? Yeah, man. It's probably an even mix because I still buy a lot of renovators. But I'm really just looking towards commercial and sort of building out that arm. I've built out a lot of residential cash flow. I probably have about 30, 35 residential cash flow deals in the portfolio as well. But now I'm going on about 15 commercial deals as well in the portfolio. So it's sick, man. And I love it. I'm always learning different things. And I've got a very experienced team in there. Like with our commercial division, man, we've got over 100 years of combined experience in there between agents, property managers, training up, going through everything within that. And then the valuers as well, like multiple valuers in there too. So it's sick, man, like going through and you learn so much different stuff about deals. And I love cutting my teeth on actually doing deals myself. And over the last like 18 to 24 months, the amount of learning I've sort of had with it. And now it's like a refined process, man. And we've got such an advanced team in there too that have had, again, like I said, man, over 100 years of combined experience in there. It's sick to then be able to apply our way of building relationships and doing deals to apply that now to the commercial perspective. It's been really interesting to watch sort of the quality of the deals that we've been putting together, man, and the yields we've been getting off things. So it's sick, dude. I love it. It's and again, always learning new things, always being open to learnings. Taking people's advice that have been there and done it, have built these portfolios, been in the game for so long as well. So it's been really cool injecting different deals in the portfolio. I mean, I've done things as small as 400 grand was one deal. And then I've done other things that was $700,000-$800,000 all the way up to over $10 million purchases as well.
Wow.
So I've done everything in between and cut my teeth on so many different things. Big refits, mezz builds, all these different things, man.
What's a mezz build?
Building mezzanine levels in things like industrial units. Configuring mezzes, unapproved mezzes, configuring, get it reapproved, all that sort of thing, man. So I've been going through so many different strategy pieces within it, man, just learning so much. And it's been a cool journey. And now it's almost like a streamlined version of what we do and what we're sourcing for clients as well. So I've been loving that, man. I've been loving it. And then obviously stepping up over the $10 million purchases, it goes into a different, even really once you go above like 3-4 million, it just, the buyer pool drops off so much. Yeah. And so you're really in almost like this blue ocean with some really, really cool opportunities, man. So I've been enjoying it, man. It's cool. I kind of, I cut my teeth on a lot of the smaller stuff. And now I leave anything sub 3 mil for clients. And then I just focus on the stuff that's above that, as if, working on that with other clients as well. So
when you talk about the commercial spaces that you're buying for your clients,
yes.
Now commercial, it can go everything from storefronts to office spaces to industrial.
Yep. Medical centers,
what does the typical commercial real estate property look like that you're buying for your client? I suppose, you're laughing out. You can't really say typical, right? But I mean,
exactly. There's such a spread, man, because commercial is such a spread of industry as well. And so industrial is obviously a heavy one for us. Man, retail, medical, office, like all the rest of it.
So whatever makes sense.
It's got to make sense specific to the location, because it's not just like cycles are so different in commercial, man, because it's all relevant to the industry and the economy in that area. Population growth, what's moving in, what industries are killing it in the area, what's picking up, what vacancies are dropping to like record lows as well. And sometimes there's a crazy opportunity in that where there's areas that have like really, really high vacancy rates over a period of time, but then something's changed in the economy or something's changed industry-wide in the area as well that's going to be like a 30, 50-year play or just like inevitable.
It's like a new massive government work site there for a new highway or something, and suddenly you have like thousands of tradies coming through every day.
100%, man. And even things like demographic shifts to people wanting to work from office in certain areas, that drive a vacancy rate from 30% down to 5%. Yeah. And we saw a lot of like really hectic blowouts in all different industries, in all different facets of commercial during COVID. And then, man, to see that sort of tighten up in some specific arenas to really, really tight rates from a commercial perspective has been really cool to watch, because then you see that rent, you see that yield boost, and as that yield boost is coming through, we see the price increase as well. So it's been really cool sort of like finding different markets like that ahead of time, or as we're seeing it trending down, and as we're understanding what's going on in the market as well. So it's been really cool.
That volatility, I guess, given that up and down, there's going to come a point, I guess, given that the yields are higher more often than not, that people would then start looking to move into commercial once they've kind of tapped out the resi market. Given that up and down, given that volatility, I'm guessing there's going to be a lot of investors that are quite a bit too nervous to do it. What would you say to them?
Man, I think the volatility needs to be understood because it's like I was saying before, like it's when something actually drastic changes in a market. So like if something sat at 20 to 30% vacancy, it fluctuated from a 10 to 20, 30, all around that. I'm not comfortable with that. It's when they're dropping and seriously dropping for a reason. So often that's where you see the actual value in an area like that as well.
So that could be like the new metro opening up or something. And you're like, well, this is going to be here for good.
Bro, there's so many things it could be, man. New distribution centers, all that sort of thing. New airports. There's so many different things.
Sure.
Yeah, they come in that are surrounding evidence of why industry will boom so hard at that. And so often, like now, build costs are so expensive. And this is the real thing to look out for. And this is what we've really noticed is build costs have become so expensive over the last few years, right? Like what it take to used to build a specky home, 5 years ago, pre-COVID, man, you could build specky homes for 250 grand. Now that same specky home's like $400,000 to $500,000. It's doubled. And if we look at the commercial space, man, like the cost of building has been no different. Like it has significantly increased. It's been no different to resi. Like we've seen that significant increase in build prices, right? And so the flow and effect of that is now it's actually extremely hard to build for the same money that they used to back in the day.
Sure.
So projects aren't stacking. So things aren't being built. So often what we're seeing is this massive deficit with no new supply coming on the market. So when you're understanding that in so many different spaces, especially within commercial, you can start to pick, okay, well, where's in a deficit? Where's trending down? Or where really looks good? And the really interesting about commercial is the data is so much harder to find than resi because resi is such a huge market compared to the tiny comparable of commercial. So it's really cool, man, like figuring that out and getting on the ground, speaking to people, seeing those inventory levels and what they're doing. Man, it's exciting. And like, it's the same as picking a growth market in residential, but different, if that makes sense. So I get super G'd up by research, man. I get super G'd up by picking growth locations before they go. And yeah, man, it's now no different in the commercial, sector of what we're doing for clients as well. So I love it, man. It's cool.
You pretty famously, whenever you go to a new location, you're knocking on doors and speaking to people to see what are the streets you should avoid.
100%.
How do you translate that into commercial?
Man, it's so different. It's so different. It's getting on the ground with agents and cross-collating information as well. And again, man, you get on the street, dude, and you walk. You have 10 cups of coffee in a day. And you go to the different coffee shops and you get speaking to people, man.
Yeah.
And
How's business going?
Literally, dude. And like, what have you been saying? How's things been happening? And it's funny, man, because like the more you sit around them and start talking to them, especially if you're there during a day and it's a quiet day, man, you get people open up there, talk to you about the area and like what they've been seeing, the transitions and everything. And so, yeah, man, sometimes it can take a good couple of weeks to sort of sit in an area and really get the feel for everything across the board. And the other thing with commercial, there's so many different facets of it, is like the industrial compared to office, compared to medical, compared to, all the different facets of it, retail and everything as well, man. There's just so many different sectors to then feel out what's really working, what's really moving in what direction, man, who's struggling, who's killing it, where's their massive tightening of vacancies. And even conversely, man, the other side of it as well is like in some areas, vacancies are so tight and yields are so strong that you're actually at a peak in some areas. So some people think certain industries are like the bulletproof ones, when in reality, it's almost like a market that's peaked out in residential.
Yeah, for sure.
And like if we can see more supply coming on because there's been so much growth, is that supply going to dip the vacancy, which in turn will dip rents and dip values? And so it's really understanding that piece, man, from so many different levels.
Yeah.
So we love to understand where the value actually is in a market and will it sustain and is it actually worth the risk?
Yeah, are you at your peak? Well, then what happens after a peak?
Exactly, man.
Yeah.
It's a come down and a trough. So it's been really, really interesting to kind of understand that, man, and figure it out and get on the ground and pick these markets and like, where are we wary of? Where do we think was going to be good and now we're aware of? Where we're a bit uncertain about that actually is looking really good. And then actively buying into those locations too. And again, dude, I get in there first, the first one that buys in there. Especially, I like to buy vacant properties in commercial because it actually gives you a genuine feel for how long it takes to lease it out. So then we can feel comfortable if we buy a vacant or a lease property for a client, we can put up the pros and cons and say, hey, Sammy did this deal as well, and this is how it looked, this is how long it took to lease, this is what we potentially did on a fit out, and all these different things, man. So yeah, man, I'm loving it. Like it's again something different I can sink my teeth into. And we talk about adrenaline hits. These are the sorts of things that I still get because it's so 2 years to me in an investing game is still fresh, especially when you're finding new locations, finding new deal types, figuring all that out. Whereas resi, man, I've been doing resi for almost 16 years.
Been there, done that.
Yeah, I still love it, but it's like I don't get that adrenaline hit of like figuring when I pick a new market. That's when I get an adrenaline hit.
Yeah,
when I
okay.
pick a new market, the team would be able to testify to this of how G'd up I get when I figure a market and I can see a market's going to boom. And we might be 6 months pre when I think that's going to happen, 6 or 12 months, and I know the entry point of when we're getting in is like perfect for the next run. Dude, I get so G'd up. You know what I mean? Like that's the adrenaline hits. I get the goosebumps and I get fired up, and everyone gets the excitement as well. So it's and then obviously the clients get to reap the benefits too, man. So it's sick, man. So and it's no different in my opinion from the commercial side when we figure we can see a niche in the market that's undervalued,
Kind
has
of
room to
cracks
grow.
the code a bit.
100%, man.
Yeah.
So it's cool, man. I love it. It's what keeps me G'd up about it all.
Yeah, well, I'm going to say this on airwaves. I think I know a fair few people in your team by now, and I'm so desperately hoping to be invited to your Sydney Harbour boat cruise Christmas parties. I'm going to put that out there so it's on the record. But we've got to go
get
back.
blown up on our Daily Mail again.
But I've got to go back because we are talking about
Yes.
ways to not screw up your portfolio when you're on the growth. Now that was, I think, a very important topic, the commercial stuff.
Yeah,
but
for sure.
one common thing that we see in SPI land is people don't come in with a strategy.
Yes.
They don't know what they're doing. They're kind of piecemeal buying stuff, and that ties into the listening to the wrong people aspect. Before your mum's like, "Oh, buy near me," and then suddenly you're out of pocket, negatively geared in a non-growth area that your yields crap, right? They're because you haven't had a strategy to go in. Talk to us. How do you build out a strategy?
Yeah, man. Lack of strategy is probably one of the biggest mistakes we see. It's kind of everything we talk about here are like the biggest mistakes you're going to potentially make in your portfolio, or people do make. And that's why like anyone listening to this, it's maybe they're an experienced investor, but they're trying to get someone else on board, or that a friend, they're trying to get them into investing stuff. Something like this is a really good one to send them because it kind of like lays the land of what to look out for. And the mistakes not to make before you start. And the non-strategy is probably the biggest thing, because if you don't have a strategy and you don't know what you're actually going out there to do and to build, the biggest issue is that you will make a mistake on your first deal. You would have to fluke your first deal to actually do well out of it, right? Because like if you don't have a strategy piece, you might buy completely the wrong asset. You might buy it at a significantly at a terrible price compared to what you need to buy it to be able to keep moving forward as well. Because you can't retire off one deal. So that's where strategy becomes so important. Man, and I think it's like there's so many different facets of it. In all honesty, man, like I have an entire module. There's about I think it's 12 or 13 lessons in School of Property that literally details the entire way in terms of building out your strategy to scale your portfolio. There would be something like 7-8 hours worth of lesson across those 12, 13 eps. And man, it just goes into crazy depth around that. And it's really understanding your position where you are right now. What's your goal? Like, what do you actually want to do this for? What do you want to build out? What do you want to get to at the back end? And then it's piecing together the journey to get to that point.
You reverse engineer it.
100%.
So you start off with the end point in mind.
Yep.
Then
come back to where you are now.
Yeah.
And then bang, how do we actually build towards that? What is the strategy? What are the steps you need to take in detail of each property, and structuring the whole thing out, man, from a financing perspective, a deal type perspective. We're talking about commercial, but so many people want to get into commercial super early. And in reality, commercial is extremely capital intensive. So unless you have, potentially doing a sell down, a couple of deals in your portfolio, you're going to clear, $400,000-500,000, something like that. It potentially isn't the right thing for you right now in your portfolio. But it's understanding that, and then how to really build it from there. So strategy, man, is huge. It's one of the most important things without a doubt.
Yeah, and I do appreciate the point of you're not gonna build your wealth. You're not gonna retire off of one asset. And this is the example that I always give when my wife and I first dipped our toe in. This was years ago. And we were like, you take that traditional approach of like, what's the blue chip suburb?
Yeah.
And then, this suburb's already really expensive. It's not going to go down. It's only going to go up. And we got outbid at auction. Thank God, thank you so much for getting outbid at auction. Because we would have been, in our mid-20s, it would have been like $2,000 a month, negatively geared.
Yeah, right.
But, sure, it was in the middle of Brisbane. It would have had some decent capital growth.
Yeah.
Probably not enough to justify it. If you put your capital elsewhere, you'd
But if it was $2,000 a month back then, what would it be now? Because it was $2,000 a month during COVID, where interest rates were in their 2%. What would it be now?
Yeah, true.
You know what I mean?
That's very true. I hadn't even done that. I hadn't even done the maths.
Dude, rates have gone from low to mid twos to now mid sixes, mid sevens. A lot of the time, depending on what rates you can get, what bank you're with. So dude, your $24,000 back then could be $50,000 now on a singular asset. That's a lot of money, man. That's a lot of money to hold that asset. So it's something to be very, very wary of for sure. And again, it all comes into strategy. Where you're at right now, what can you actually afford? What price point should you be buying at? What style of asset?
Don't
then
just shoot
what
from
location?
the hip. Because people are shooting from the hip of it's near family, it's near this, it's near that, we'll buy it. Well, no.
Yeah. Because the most expensive thing that you'll ever buy in your life is real estate. So you have to have a strategy. You have to know what you're doing. Man, to make sure you're making those correct purchases and you're building it in the right way that's going to enable you to keep moving forward.
So on the flip side, there's the risk of not having a strategy. What about when people deviate from their strategy?
Okay, so the next really big thing from a strategy perspective is then hearing all these different things. And sometimes you need to remain hyper-focused, because when you hear all these different things, again, like commercial, you bring commercial in too early, you might completely tap yourself out. Yeah. It's understanding what you need in your portfolio and keep it moving forward. And the biggest issue we see people make is people deviating from that. Let's say yourself, being happy, getting yourself a couple of really good blue collar sort of style deals, like, man, good middle of the run markets, great affordability, good yields, priming up for a boom. You buy a couple of those, you get a bit of growth, and you go, oh, you know what? Let's go buy that blue chip now because we've got a couple. And you go buy the blue chip, and then all of a sudden it's costing you $50,000 a year to hold that one asset, and your serviceability is stuffed and the game's over. When if you just stayed on the game plan that you'd set out, or that potentially you'd worked with us, was, you figured it out yourself, whatever, you would have been able to keep moving forward in the right way. So,
for sure.
Man, you always got to be fluid. I think maintaining your game plan and sticking to it is super, super important, your strategy, but you also need to be fluid in terms of has anything changed? Is there anything we need to take into equation? Have our pays gone up? Have they gone down? Is there a child that's coming into the equation? All these sorts of things. Has the market changed? Have interest rates gone to a different level? Or are they coming back? All these different things, man. You have to be very fluid and be able to mold your strategy as it goes. But the underlying strategy, if it is correct, you need to stick with it, because if the compounding effect of sticking with the correct strategy will yield the biggest dividends of anything. And that man is also staying hyper consistent. Don't buy a deal or two deals and then go not do anything for 3 years. Maintain the strategy, stick to the game plan, build the portfolio out correctly. And I guarantee you, man, that the consistency of just doing that will make you wealthy. Just literally doing that. Because you think about it, let's say you made the game plan of 2 deals a year. I'm going to buy 2 deals a year for 5 years. Okay, sweet. In 5 years, you've got a 10 property portfolio.
Yeah.
You've got the 10 property portfolio. Yes, it's easier said than done. But if you've got the right strategy in terms of how to get there, you literally map the whole thing out and you take the right steps the whole way through. And even if a few things derail, instead of doing it in 5 years, do it in 7 years. Okay, in 7 years, you've got a 10 property portfolio.
Yeah, and then once you have that 10 property portfolio, you might hate this sentence I'm about to say, but you can start being a bit more creative in the sense that, maybe the passive income thing's not for you, or maybe this or maybe that, depending on where you are and what stage you are in life. You now have the equity foundation to do creative stuff should you wish to.
Yeah, man, it gives you options, right?
Yeah.
But what I find
But you didn't do that in year 3. You did that in year 10 or whatever.
Yeah, well, man, I think the other thing as well is what I find is people genuinely deviate closer to the start. Yeah. You get 10 properties in, man, in a proven strategy. You typically don't deviate because it's proven. And you're
sticking to it.
Makes sense. Yeah. Because you've gone that far in. We typically see people deviate in properties 2, 3, or 4 or something like that. And then they get to a few years because they might have stunted their growth, and they get 3 years later and shit, those 1, 2, and 3, they've all done this.
So what are some of the most common ways in which people deviate?
Man, they buy into things like blue chip.
Yeah, okay.
Commercial, too early. Commercial's great at the right time, and if you've got a big lump sum of cash and you've still got a resi portfolio you can keep building, that's sweet. Bring commercial in there. A nice cash flow injection could be the right thing, but bringing it in too early, things like your blue chip plays that just kill serviceability. Man, going and buying an off-the-plan apartment for a holiday home or something like that. Man, buying the primary residence. Bring the primary residence in 2, 3 years early because you've had some wins. Yeah. Those sorts of things, man, they're just, deviating from what works and the game plan is typically where we see people fall over.
Because suddenly now you've got all these savings, you've built up a couple of $100K in equity, and you're like, hectic. Let's buy that primary residence, and then from that point you shut off.
Yeah, man.
Game over. Not game over. It's not game over, is it?
It's not all over. Well, it depends, man. You go buy it to your max capacity. It is for now.
Yeah.
You know, it is game over for now. And this is where like I really challenge people to really have the end goal in mind and focus on that end goal, because again, you know, you get 2-3 properties in, you're not buying your dream primary residence. Remember what we said earlier, like only buy your dream primary residence when you can afford it, when you can afford your dream primary residence and you've built the resi portfolio, you know, the investment portfolio out first. Because once you've built that out, you've earned the right to then go and buy almost whatever you want. But what you'll find is, and even now, you might think about it and you go, okay, so what I might love to buy as a primary residence is, let's say it's 3 mil or 4 mil. By the time you build
We
out,
are in Sydney.
Okay. No, I'm just saying for now, right? Wherever it is in Australia, but because where your mind's at right now is like your dream primary residence might be 10 mil, like where you actually would love to live.
Yeah.
But on the income you're on now and at their age you're at and the equity position you've got, you might not even be able to fathom that. And I would say 80% of people couldn't fathom what their actual genuine dream home is. Yeah. And myself, man, got rewind 5 years. My dream home probably would have been a 3 to 5 mil primary residence. Yeah. Whereas now it's probably like a 10, 20 mil, something like that. You know what I mean? To be honest, I don't even know what my exact dream primary residence is. Like I'm still figuring that out. But like I've earned the right with the portfolio that I've built to think a little bit differently. And man, like so often what we see is people change their opinions. They think it's 1.5, 2, 2.5, 4, whatever it is. And then all of a sudden they start building out a really significant portfolio and they have that switch, that shift. But what we find as well is it happens in stages. Yeah. And so it's cool, man. It's something to embrace. And yeah, it's just something to sort of build on, work on over time, but stay hyper-focused on that strategy, because that's what's going to get you there. That compounding effect of sticking to the one strategy, if it is the correct strategy, is what'll make you seriously wealthy.
Yeah. And I suppose your life changes as well. You know, if you're, 25 to 35 and you look at it and you're like, well, what would my dream place be? Oh, your dream place might be a 2-bedroom place in Bondi. Yeah. You know, in terms of square meterage, pretty humble. But I mean, in terms of absolute cost, like 2, 3, 4 mil, right? But then suddenly you have a kid. You go, oh, mate, this is like 80 square meter place in Bondi. It's actually
not big enough.
It ain't good. Yeah, I hate this. And so you get and the way that and then your dream place is now a townhouse. Yeah. Well, that's going to take some creativity to get to. Yes. Of course, with this, where one of the APS philosophies and one of your philosophies, Sam, is 2 a year. Yeah. Stay consistent 2 a year, more if you can. How do you manage cash flows around that?
Man, again, I think that really comes down to the individual and what they're trying to build out. I think it always comes down to market selection as well, and just being relevant with what you actually need in the portfolio. I say 2 a year because if people can genuinely push and get themselves there 2 a year and stick to that over a 5-year window, you're going to build a double-digit portfolio. And like even if you're doing whatever you need to do to kind of retain that portfolio, build that portfolio, hold it, if you bought in the correct growth location, you're going to get crazy results, right? And so you're going to be able to leverage off that. And even if you get years 2 or 3 in, and property number one's done a few $100,000 or a couple $100,000 worth of growth, and you can sell it off and net that. Maybe you then go and inject that cash into a really high yielding commercial asset. And maybe you keep leveraging the other resi deals you hold. But once you offload that first one, maybe you go inject it into that, which will again inject a nice hit of cash flow into the portfolio to balance out the books. But again, man, that all comes into that strategic game plan, that strategic planning of what you're trying to do. But not everyone can do 2 a year, and I fully appreciate that. But like if you start changing your mindset and your psyche to that's what's possible and that's what I should be doing, and that's what I really should be trying to work towards. And maybe it doesn't happen in year 1 and year 2, but maybe you just do 1 in year 1, and then 1 in year 2, and then all of a sudden you get to years 3 and 4, and the equity's really building up, and you can go to the second, you can go to the 2 a year, and everyone's different. Everyone's ability in terms of what they can do is obviously relevant to their situation. But I just find the compounding effect of pushing for that as a minimum, that's a game changer.
Because you're aiming for the stars. You aim for the stars, you'll probably hit the canopy. Yeah. If you aim for the canopy, you'll never get off the ground.
Yeah, exactly, man.
Something like that. I think that's how the saying goes.
Something like that.
Yeah, that'll do. That makes a lot of sense. I think on one of our last podcasts, and it might be worth putting this in the show notes, but you and I had a bit of a chat about that lazy equity. Yeah. That you've built it up, so use it. And this is where can you talk us through, because you kind of alluded to it, the consolidation tactics. And you use that. You get to that point, you might have a really big portfolio, you might you will have the kids, so you're going to have to consolidate it. How do you go about doing that?
Man, consolidation is it's a crucial part of the journey. It's your exit strategy, man. No one ever talks about exit strategy. I love exit strategy.
That is true, and this is a Sam Gordon thing.
It is.
Because so many people, they're like, nah, never sell. But it's like, but then I suppose the way that I look at it philosophically is, I'm going to die with a 100-house portfolio, but I've been living in a shithole. Yeah. I'm not allowed to swear anymore. I've been told I'm not, but we can beep it out. Because I've been trying to service it, but I've never actually enjoyed my life because every dollar has gone into it. You know, at what point do you say, hey, I deserve to reap the rewards of what I've sown?
Man, I think it's just treating your portfolio like a business, you know, which I think was actually the title of the last ep or something along those lines, man. I think like when you treat your portfolio like a business, you understand that once a property has done its job in the portfolio, dude, clip it, you know, like especially a growth property. If it's done its job in the portfolio, man, clip it, reap the rewards, whether you roll that into a different asset, whether you reduce some debt, whether that goes towards a massive deposit to build, to buy the primary residence, or whether you sell it and you clear 500 grand, you go buy a Ferrari, whatever is relevant to the individual.
Is
man.
Is that speaking close to home?
Yeah, 100%. That's what I've done, gone through, man. It's like it's all part of it. Yeah. You know, and you know, people pay out blue collar, man, dude. I've sold a number of blue collar properties that have gone through significant growth to buy supercars that I absolutely love and buy them in cash, man. And like, I've just gone through the strategy, and the properties have achieved what I need them to do from growth, and I think the market's done, so I sell it. And like the whole idea of holding forever, it doesn't make sense, because historically, if you look at the property markets in Australia over the last 130 years, they all go through serious periods of stagnation. So it's like, what's the point of holding it during a period of stagnation? Either sell it and, you know, let's move that money into a different market somewhere else to multiply it elsewhere, or let's sell it and buy the primary residence,
for sure,
put it into commercial, buy the supercar, whatever it is, whatever it is that's relevant to you, that's going to give you going to keep you moving through the strategy initially. I wouldn't say, you know, get 3 properties in, sell the first one and buy a supercar then. Like we're still on the journey. We're still on the journey, right? But like you get towards your end goal, and maybe you throw a couple of extras in for that specific purpose. Man, it's just all part of it. I love the exit strategy. It's a huge part of it. Dude, I'm going through at the moment. My EA's gone through and got all the appraisals on a massive, I think about 25 properties of my own at the moment. I'm going to shift about 15 to 20 of them in the next, 3 to 6 months. I'm just going to go through a massive sell down in my portfolio, because some of those properties have,
they've hit their peak.
Dude, some of them have like tripled, quadrupled, that I've owned for, there's one in particular I've owned for about a decade now, and it's quadrupled. So it's nearly 4x, cost price. I've had a bunch of others that have tripled, and then, man, so many that have doubled as well, or more, 100, 120, 150%. So just going through, man, I'm consolidating the a portion of the portfolio. I'm banking the wins, man, banking the profits. Yeah, I pay a bit of capital gains tax. Who cares? If you pay a bit of capital gains tax, it means you're profiting significantly.
Means you won. Exactly, man.
Yeah. And we're in property to win, man. We're in to make money. And at the end of the day, bro, you can't eat equity. You know what I mean? Like you can't. I hate the idea of living lifestyle of equity. Because at some point you're going to have to pay that back. I would just prefer to bank it, know how much I've got to work with, and then use that, man. Use that for whatever purposes. So I'm a massive advocate of the exit strategy, man. I think it's huge.
I think there's probably a group chat in the Gold Coast of luxury car dealers, and they see you walk in and they're going to be texting each other. Oh, Sam's here. Yes, it's payday. But
That's a bit of an over-exaggeration. I don't have that many.
Maybe. I can't even read my own writing. Wrong
asset, wrong market.
Wrong asset, wrong market.
Yeah.
Gosh, I thought we were going to do a one-taker, and then I've ruined it.
That's so good.
You mentioned before one thing that I want to go back to, and that is, making the wrong decisions in terms of asset market, the off-the-plan unit. Yeah. I think you gave the example of. That can, if you do that early on, that can completely throw out your journey.
For sure. Man, wrong asset, wrong market, wrong price, all those things massively come into it. But wrong asset, wrong market is probably the killer. It's the real big one. Man, wrong asset being something like I was saying before, commercial at the wrong time. Again, love commercial. Don't buy it as a first property. Yeah. In all reality, man, like it's too many people bring them in way too early in the journey. But figuring out when is the correct time to bring something like that into the portfolio can be critical to actually growing a portfolio correctly as well. But then wrong location is a huge one, man. And like if you don't have the understanding in terms of where you should be buying, what is actually going to put pressure on this market to give you growth, not just looking at the historic long-term capital growth of, this place grew by 15% per annum over the last 10 years. Yeah, Matt, how much growth has actually got left in the tank? Understanding these things intimately. And sometimes they have a lot of growth left in the tank because of something else that's moved into the area, or something else that's got a demographic push on the market that can provide another significant wave of growth.
I think on that note, Darwin, was it Darwin? Darwin had a point where it like doubled over 5 years and then stayed flat for like 15. Might be exaggerating.
Bro, look at Perth, man. Perth,
Yeah.
2004 to 2007, man. It did like 200% growth, like 200% growth. And then from 2008 till 2021, it did nothing.
Sat.
14 years of no growth. And then it's doubled again in the last 3 years.
Yeah. Yeah.
It cycles, man. You
Yeah.
know, and so it's understanding that, you know, it's really understanding that intimately. And man, we were buying properties in 2020 in Perth that people had bought in 07 and 08 for $100,000 more than what we were paying in 2020 and 2021.
Wow.
Crazy, man. You know, so it's like if you'd bought in then,
How did you have confidence to do that?
time in the game.
You kind of had the gut feeling that this is going to be the next boom suburb or boom city.
Yeah, and I went and got in the ground, man, and like we were buying, you know, 4x2s for 280, 300, 350 grand, 5 minutes from the beach. You know what I mean?
Yeah.
Like for a 4-bedroom, 2-bath, 20-year-old home, it was crazy. It almost didn't make sense. Like my hesitation was almost like, this doesn't make sense. It's so cheap. But it was just quite simply, there was so many different factors pushing on the market as well. But man, it obviously writing on the wall, dude. Stuff that we bought at 300 grand, now we're selling. Some people are selling for 700,000-800,000. You know, 3 years later. 3-4 years later. So it's man, it's all about just really understanding it from that piece. And I think like, if you don't have the complete confidence to do it yourself, just use a professional because you're competing against so many people these days. And this isn't even just me saying it from a buyer's agent perspective. Oh, you know, come hit up Australian Property Scout, blah, blah, blah. Like like if you don't have the ability and the time to put into it, the fee that you'll pay for a BA, just as a minimum, a good BA, man, it should cover itself anyway. What you pay for a good BA should cover itself in terms of the discount they should get you, but also should solidify you being in the correct growth location, the correct market. Because you know the heavy lifting that comes from that piece, even if you got yourself a 50 grand discount, right? If you got yourself a 50 grand discount, and the market did nothing else for 10 years.
You're still up.
Mad. It's not bad. Like it's a joke.
I mean, that's
It's
bad. That's
bad.
I mean, that's bad. But I mean, in terms of the
But
I interpreted that in
10
terms of, I didn't hear the 10 years. I wasn't paying attention to that. I thought you meant like you pay your 20 grand BA fee or something, but then you get it a 50 grand discount.
I get you. But what I'm saying,
10 grand's off bad.
Yeah, but man, like let's say even if you got 20 grand discount or 25 grand discount, whatever, but then over the next few in comparison. Or even really paid market value. I'm not an advocate of paying market value, but if you could pay, 50 grand as a discount and the market did nothing, or you paid 10 grand, you got 10 grand, 20 grand, 30 grand below market value instead, yes, you don't have quite as much at the start, but if that market then does 50, 100 grand a year for the next 3-4 years, man, you're laughing, and that's what you need. And so if you don't have absolute confidence in making that decision, dude, hire a professional or spend the time to really research it properly to make the correct decision as well. So, and this is something that we have in School of Property, man, because we fully, realize that 50% of the people who are going to do School of Property are probably also trying to do it themselves. So there's a module in there around like selecting the correct growth location. So man, unpacking that and understanding that from that perspective too, man, it's a game changer.
Yeah, for sure. No, I couldn't agree more. What would you say? Bit of a hard question. Well, what do you say about all those overnight BAs that are popping up?
It's not a hard question, man. I think it's like in reality, dude, like, people are trying to change career. They're trying to get out there and do something different. But like, if they haven't got the runs on the board, man, like how do you compete with someone with 15 years? Like I got 15 plus years experience. There's other people out there with 20 plus years experience. Other people with 5-10 years experience, whatever it is. Like, you're just opening up or you're just coming out to have a crack. Maybe you bought one investment property or 2 investment properties or something like that. Like the ability, and this isn't me shitting on them at all. This is just complete, transparency around like, who do you want to put your money with? They could be half the cost of a super experienced, high quality BA. But if they put you in that market that does nothing for a few years, or they buy you in at the top of a cycle, or they pay 20 grand above market, because it's all an understanding.
Here's an amazing house and land package.
Yeah,
where there's
dude.
30,000 other homes that are about to pop up over the next 4 years.
So it's like you're paying for experience. You get what you pay for, right? And you've got to understand like the level of experience that needs to be, especially in this market. We're in a very different market now. So like the level of experience that you need to have in this market to navigate it properly and make the correct decisions is completely different from 3, 4, 5 years ago.
For sure.
So man, I think like, I'm not going to say anything further on other BAs. Like people can do whatever they want, but at the end of the day, man, like you need to have that experience piece, or you're not going to get that same result.
Yeah, and I look at it purely, and I think this is a conversation that we had last time, but it's a case that so you're there negotiating. You're doing it for yourself. Let's say you're doing it for yourself. You're negotiating with them. and you're negotiating with a real estate agent that might have 50 negotiations a year.
Yep.
And this is something that you do once every 10 years because you're flying solo and you're not using expert advice, you're going to be trampled.
Mate, I'll put one thing back on you. How many real estate agents are only negotiating 50 times a year? I would challenge that most real estate agents are probably negotiating 50 times a week.
Yeah.
Or 50 times a month
Yeah,
minimum. You know what I mean? Like if
Yeah.
it's 50 times a month, that's one negotiation a day.
Yeah.
If they got, let's say they're listing 2-3 properties a week, they're probably negotiating with 5 or 10 people a week per property. You know what I mean? So like we're talking massive numbers. We're probably talking potentially thousands of negotiations a year, and you go find one property and then you're trying to negotiate. And then what if they've been doing it for 10, 20 years?
Yeah.
You're talking about someone that's a hyper experienced expert negotiator, and you're going to go out there and have a crack on it.
And you're going to try and,
but also
you're going to try and outgun them.
But man, even in that instance, like, dude, like how much are you missing that's being sold off market?
Yeah,
Like,
for
dude,
sure.
we buy 90% of what we buy is off market, you know, and the 10% that we buy on market, like we still know intrinsically the value's there from a specific reason, or maybe it's a crash contract, or, there's so many different reasons as to why we may get a deal on market as well.
Like
for
a
that,
distress
for that 10%.
sale and stuff.
Yeah, well, we may have a relationship with the agent who just had to list it, and maybe a contract or two's fallen over, and then they go, oh, you know what, we're going to go with a bulletproof buy that we know is, and again, we may negotiate a bit off that side as well, but. Even outside of on-market transactions, dude, 90% of what we buy, 90% plus of what we buy every single month is off-market.
Yeah.
So, like, how many transactions are you actually missing that are happening
sure.
every single week as well?
Yeah, you can't necessarily do that unless you've got the relationships on the ground with
which takes so long to build.
Yeah.
Yeah.
Which is why, every time I think I email you, I always get an out of office that you're on the ground.
Always on the road.
You're
man.
always on the road.
Always on the road.
Looking at how people really undermine building their portfolio. Last but not least, Sam, wrong attitude.
Yeah, man. Attitude and psychology around investing is huge. The absolute, easiest way to explain this, like you have to have a bulletproof mindset, and that takes time to build. Like in all reality, you have to look at it's like a like a TheraBand. You know what I mean? Like the more you do it, the more it stretches. You know what I mean? Or an elastic band.
Yeah. Okay. Yeah.
Well, you don't train, bro. A TheraBand. You know what I mean?
Is that like one of the leg ones?
Yeah.
Okay. Yeah.
Or even like an elastic band or whatever, man. Like over time, things give, right?
Yeah.
It's like a new pair of shoes that are tight. Over time, they give. It's all. Yeah. Whatever analogy you want to use to like creating a bit of resistance that then gets broadened further and further out. And man, you have to go in with the realization that investing is not going to be blue skies and rainbows and lollipops and all the rest of the sort of stuff. Shit is going to hit you, man. Things are going to come up and they're going to hit you and they're going to hit you in the face. And you need to have the correct mindset. So if you go in thinking it's just going to be that, great and no issues and all the rest of it, you're setting yourself up for failure. You would be better off to set yourself up expecting it to be hard. I fully, push people to expect it to be hard because your first 1 to 2 years might be hard. It might be laborious. It might be, all the paperwork that's involved with getting a loan doc and all the rest of the sort of stuff, man. All that sort of stuff, it's like, it will push you mentally to begin with. And then you just get to a point, in the negotiations around building and pests or purchasing or even property management, bad tenants, all this sort of stuff. It's going to happen, and ultimately, man, at the end of the day, like nothing great is ever achieved without going through a bit of hardship. You know what I mean? So it's all part of the journey. And I just think, man, I just wanted to sort of, express as the very final point of obviously this, man, you're setting yourself up for failure if you're not expecting some hardship and just some things to come up in the journey. So just, man, lock in, get ready. If you're dealing with some shit at the moment or you have and you're not sure if you're going to keep investing, we've all been through it. You're not alone. Like, you're not the only one. This isn't just you that's gone through this particular hard point, or maybe a bad run of tenants or something like that. It's all part of it, man. And sometimes, like, okay, well, where can we flick the switch? Okay, I've had a bad run of tenants on this one property. Okay, sweet. Is it maybe time to look for a new property manager? Solutions-based thinking. How can we switch this thing? Well, where can we make a bit of a change, a bit of a difference to get a better result? So it's always having a look at that, man, and ultimately, like, again, sticking to your game plan, sticking to your strategy, keeping your head clear, head straight. Yes, we all have bad days in the investing journey. It's all part of it, but yeah, man, just keep pushing on.
You got to push through.
You can achieve it.
And I mean, the results-based thinking, and this is again to your point. We've all been there, right?
Yeah.
When something really bad happens and your anxiety peaks and you can't think straight, and you kind of get flustered. You're not giving yourself solutions. It's only extra problems. But that's where, like, when you partner with the experts, they're like, "Hey, man, okay, really sorry that happened. Maybe given that the other properties in this area haven't had that same run of bad events." Let's look for the other property manager, and that's that clear head, and that's where you partner with the experts who can talk you off that ledge, so to speak, and guide you on your journey.
And man, this is where we always like recommend to our clients, if there's ever an issue, especially something around a property or property management or leasing or anything like that, always come back to us and let us know. We always like strongly push for our clients to do that, because sometimes, man, like we may put you with a property manager who might have been great at the time, and then there might be a change internally.
Yeah, they could have moved on.
Exactly, man. You know, or retired, whatever. And like so often someone else will come in, or someone just goes through a bad run and is doing incorrect things, or they're just trying to impress you to get top dollar rent because you've been referred by APS or School of Property or something like that. But ultimately pushing for top rent in a certain area might align with getting a bad tenant. You know what I mean? So it's like, is it realigning expectations on market rent, renting it for correct market value rather than going for top dollar?
Yeah, for sure.
And then getting yourself a better quality of tenant and potentially more quickly as well. So it's, man, solutions-based thinking is everything. And if you apply it to an entire portfolio, including your mindset and like how you're running the portfolio as well, mate, you're setting yourself up for success rather than, if you think it's all going to be hunky-dory and it's all going to be, sunshine and rainbows, you're setting yourself up for failure. So, mate, do the right things there. Expect the worst, prepare for the worst, and
hope for the best.
That's it, mate.
Now, you've mentioned School of Property a few times.
Yeah.
How can people get involved?
Mate, head over to www.schoolofproperty.com.au. We've got one of our consultants there. He's a very experienced property investor as well, doing strategies with plenty of clients, incoming to see if it's a correct fit for them too. But yeah, man, super experienced, Brendo. And yeah, he'll be able to walk you through everything. So go on there, mate, book a discovery call, and
How big's your team now? It's a growing team. It's big.
Yeah, I mean, we've obviously got so many different facets of the business as well, man, because we've got APS Resi, APS Commercial, which is obviously its own division. We've got School of Property. Yeah, man. So there's a lot going on,
mate.
Man.
It's going to be a big 12 months ahead for you,
mate. I'm excited. It's cool, and there's a lot coming, over the next 12 months as well. And I'm just really excited to be helping so many people on this journey of building wealth through property, man. So it's awesome. I love it.
Yeah, it's exciting, mate. I think that is all we have time for today. Thank you so much for joining us on the podcast.
Absolute pleasure, mate. Thank you.
That was Sam Gordon from Australian Property Scouts. Actually, what title are we taking for you? Founder, CEO, owner?
I don't know, owner, man, director.
Owner, director of...
I don't know.
Owner, director of Australian Property Scouts. I think everyone already knows you that listens to this podcast, and that is all we have time for today on the SPI show, and we'll be back at the same time next week. But until then, bye-bye.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property, or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.